Instead of asking what's the best ETF, what if you build the best basket of ETFs for your specific goal? Today I'm going to build 5 completely different ETF baskets, run every one of them through my portfolio planner, and see which one actually gives you the best combination of growth, income, and retirement success. So stay tuned. Welcome back to Simply Money. One of the biggest mistakes I see investors make is trying to force every ETF to do everything. They want growth, income, downside protection, dividend growth, all from one investment. That's not how portfolios work. Every ETF has strengths and weaknesses, but when you combine them into baskets with a purpose, everything changes. Today we're going to build 5 different retirement baskets. Each has a different objective. Then we'll stress test every basket using the Simply Money Portfolio Planner to see how they compare. Basket number 1 is going to be the foundation basket. We're going to look at a combination of VOO, SCHD, DGRO, and VXUS. The goal of this basket is to build long-term wealth with reliable dividend growth. Some of the pros are its highest historical appreciation, strong dividend growth, very tax efficient, lower fees, easier to stay invested, and excellent inflation protection. But with all the good, there's also some cons you have to worry about. With lower starting income, requires patience, less exciting during retirement, and income may not cover expenses for years. This is typically good for 30 to 50-year-olds, people still accumulating assets. Basket 2 we're going to look at is the balanced income basket. This is going to be a balanced combination of SCHD, DIVO, JEPQ, and GPIX. The goal of this one is to blend appreciation with meaningful income. Some of the pros will be higher income immediately, good balance of growth and cash flow, lower volatility than aggressive income funds, and comfortable retirement transition. But the cons are slower growth than VOO, income lower than high-yield portfolios, and covered calls can cap upside. I think this is good for 45 to 65-year-olds, pre-retirement investors. Now let's look at basket number 3. And again, stay tuned because we're going to plug all of these into the portfolio planner and see what the actual numbers show. But basket 3 will be high income basket, made of SPYI, QQQI, CHIPI, and IWMI. The goal of this one is to maximize retirement cash flow. The pros would be very high monthly income, less reliance on selling shares, strong cash flow during retirement, and excellent for filling income gaps. But the cons? NAV erosion risk, distribution risk, lower long-term appreciation, and requires monitoring. I think this is good for retirees and income-focused investors. Basket 4, what we'll be looking at there is the dividend growth basket. That'll be comprised of SCHD, DGRO, VIG, and DGRW. The goal of this basket will be to grow income faster than inflation. The pros on this basket will be growing dividend stream, historically resilient companies, lower volatility, and good appreciation. The cons? Well, you have lower yield today, it requires time, and less attractive for immediate income. I think this is good for long retirement runways. That brings us to basket number 5. The opportunity basket. The opportunity basket is going to be comprised of SCHG, JEPQ, CHIPI, and AMDW. Now this has got a caveat because AMDW right now is a great opportunity, but over a 30-year runway, this is one you'd definitely be wanting to look at changing and moving things in and out of. Again, this is not a buy and hold type basket completely. The goal of this one is to blend aggressive growth with income. Some of the pros are highest upside potential, strong income, can outperform in bull markets, and flexible allocations. However, the cons are highest volatility, sector concentration, greater drawdowns, and requires periodic rebalancing. I think this is good for investors comfortable with risk. We're going to look at the first two baskets here, a foundational basket and the balanced income basket. And I have those set up on the Simply Money Portfolio Planner. If you've never seen this, this is available down at the link below at Buy Me a Coffee. We have that in the description. Just click that link. There's a shop with all of our spreadsheets. This one's great for really planning out and comparing different portfolios and funds. So the first basket we have set up here, you have VOO, VXUS, DGRO, and SCHD, and I have 25% going into each of those. The second basket, we have SCHD, DEVO, JEPQ, and GPIX. Again, 25% going into each of those. We're starting out with a $10,000 initial investment. We're accumulating for 30 years. Come over to the deposit rules. We're going to do $500 for 30 years. And again, that's being put into the same funds, 25% each. We're going to compare one, then we have to flip over. As you can see, I have the first one set up in the conservative portfolio, the second one in the moderate portfolio. This isn't because one's conservative, one's moderate. I'm just using this to be able to run two at a time. I'll go in, I'll have to plug in the other tickers. We're going to run 5 different scenarios, so we have a lot of different tickers, and this is going to give us a chance to go and look at these two baskets first. So again, come to the deposit rules. We're going to look at the moderate first, so we have that set up on Rule 1, where 25% goes into each of the funds. We're not taking any withdrawal, so all this is zeroed out. This isn't impacting anything on the forecaster. Come over to the Forecast tab, come up here and click Model. We want conservative. We're going to look at the first basket, and then we'll look at the other. If you're looking at this tab, this is only for initial investments. You can look at this as a quick summary. This is not taking in consideration any deposits or any withdrawals, so you have to remember that. But you do have to come over here to change your model. Now, if you're just doing an initial investment and you want to see what a fund would do, this is a great tab to just look at very quickly. Shows you the portfolio balance and the generated income that you could expect each month along the way. But to get the final data with income, deposits, and withdrawals, even though we don't have any withdrawals in this one, we are doing $500 a month for 30 years. You can see this first basket, VOO with $570,000, VXUS with $310,000, DGRO and SCHD both around $530,000. Slide over here. The portfolio balance, $1.9 million, and it would be generating at that 30-year mark about $9,100 a month. So again, for younger investors, long-term, this can show you the runway. It can show you how over time and that compounding, the impact it can have. It shows you here the deposits made each month and how it was split up, and that's just been accumulating. And you could go ahead and say, okay, now I want to turn on some withdrawals starting year 31 and see what that would look like. You can do different things. Up here, you can decide I'm going to redirect some of the income to a different fund, but we're not doing that on this scenario. We're just comparing these different baskets. So we'll recap this here in a minute, but we're going to look at basket number 2 now. We come back over here, switch this to moderate, and you can see that the deposits, we have to go here and change this to 0 because we have the second basket set up there on rule number 2. So 25% of the deposit goes into SCHD, 25% to DEVO, 25% to JEPQ, and 25% to GPIX. Come over to the Forecast Pro, and we'll just come back over. You can see that they all about the same, between 300 to 500,000. This one did a little bit worse on the overall portfolio, 1.6 million. But look at the income that it could expect to generate at that point, $19,000 a month, a big, big jump compared to the other. So for some people, they're like, yeah, I'm going to build that income. I'm going to see how that does. Then I'm going to take and turn that off and start taking the income. I won't have to sell anything. Yeah, I'll have a smaller portfolio. A lot of people have different reasons why they want to do this. Again, that's why we're looking at these baskets, because different goals require different investing. All right, let's jump over and look at basket number 3 and basket number 4. Okay, so now we're looking at basket number 3 and basket number 4. Remember, basket 3 was the high income basket, and basket 4 is the dividend growth basket. What we're looking at here, again, I set up the basket 3 into the conservative with 25% each going to SPY, QQQQI, IWMI, and Chippy. In the moderate, we set it up to show SCHD, DGRW, VIG, and DGRO, each getting 25%. Same scenario, $10,000 initial investment. We go ahead and we put in the deposits of $500 a month, split 25% into each of those funds again. Come over to forecast, make sure we're on the model that we want. We're starting with the conservative. So we're looking at basket number 3, which we show here. Now it did a little better. SPY, QQQI, look at those, and Chippy, 1.4 million. Again, we don't know these funds here. We don't have the history on them. So forecasting forward is always much more difficult. We truly don't know how these are going to handle market cycles and recover. We make our best speculation. So take that in consideration as well with these high income funds that we don't have the historical data on. But it's showing that you'd be at 3.1 million. And the income, look at that, $66,000 a month. And that's what people are looking at with these high income, feeling they can build and build and build share counts, and that will just continue to drip. And when the time comes, they'll have this extraordinary income. Something to monitor, but you can see the outcome on that is extremely, extremely bullish. Now let's look over if we switch this, and we will change this to the 4th basket. We're looking at changing the deposit, so 25% goes into SCHD, DGRW, VIG, and DGRO. Change the forecast model to moderate. Come over to the Forecast Pro. And this one, very similar to basket 1, 1.9 million with $9,100 a month of income. And again, so those are just giving you the opportunity to see those. We'll slide over. You can see they all about equal, about $500,000 each. DGRW a little bit lower, but when you come over here, you can see that the income being generated is very healthy on that as well. So that's basket 3, basket 4. Now let's look at basket number 5. Okay, so for basket 5, we have it set up here in the conservative model. And you can see we have SHG, JEPQ, Chippy, and AMDW. Again, this is the 5th basket, the opportunity basket. This would be what we would consider for investors comfortable with risk, much more volatility, but also higher upside possibility. So let's see what this one's going to look like. Again, we set the deposit rules to $500 a month, split evenly in those 4 funds. Come over to forecast, make sure we're on the conservative model, and then go over to the Forecast Pro. You can see SCHG would be just under $1 million. JEPQ about 475,000, Chippy at about 1.4 million, and then AMDW, look at that, 3.6 million. Now again, this is 30 years. Do we think semiconductors are going to continue on the bullish market to bend for 30 years? I don't know. Technology is so fast. I think we have a good 5 years with it still. In my opinion, it may be longer, maybe less. Who knows? Technology is moving so fast. What will be the next thing? And this is the type of fund that you're going to kind of want to keep an eye on. Something like SCHG, you have a blend of funds. So companies are moving in and out, where AMDW is just following one company. And that company may continue to do great, or it may slow down, or it may disappear totally. We don't know. So this is definitely a basket you would want to watch and probably have things moving in and out of that are much more the aggressive growth type funds and are paying the income, because you have Chippy and AMDW that are paying tons of income currently. Will that continue? Again, if the volatility slows down, probably not. But let's see what, with the current conditions and what's been happening, what it could do. And that's where it gets really crazy. Look at that, 6.5 million. But look at the income that it would generate if it compounded and continued. Again, I don't think it would do that for 30 years, but you can see the power of that with these high octane income generating funds. But if you're moving different companies in and out and getting those new sectors as they come in and capitalizing on that, that is possible. Those are your 5 baskets. I want to back this one up a little bit because I think if you're in this, you're probably not going to hold it for 30 years. But let's just say we have 5 years of this. Well, here you're looking at that $10,000 and investing $500 a month, turning into $67,000 and producing $837, compounding with that high return and yield if it did sustain that we're looking at. So here's a quick comparison table. We have our foundational basket, great for growth, okay for income, great for stability, I believe best for young investors. The balanced basket, good for growth and good for income and stability. This is your pre-retirement people. The high income basket, not great on growth, but great on income and decent on stability. This is for those who are retired that are looking for the income now. Then you have your dividend growth basket, good growth, okay income, and excellent stability. This is built for those wanting long-term income. And then the opportunity basket, great growth, good income, but stability is low, and that's something you'd have to keep an eye on. You can use this sheet. You can put different funds in here, allocate how you want, put different deposit amounts, different withdrawal amounts. This is available for you to use. This is why we do this, to show you the different scenarios and what you can play around with and kind of plan out, whether it's for 5 years or 30 years. And you can even plan out like withdrawal strategies. How will it impact you? And so those are our 5 baskets. Remember, every fund has a purpose. Know what your purpose is. Know what your timeline is. Know what your risk tolerance is. And each of these different factors can determine why one fund might be perfect for you and not good for me, or vice versa. We are all individuals. Personal finances are personal. Always remember that. This is not financial advice. This is for informational and educational purposes only. That's our video for today. Thank you for joining me. Don't forget to hit that like and subscribe button. We'll see you next time on Simply Money.